Okay, we should be recording now. All right, let's go ahead and get started. What I wanted to do first was show you some of the markets we trade. With futures, this is what we trade: Australian dollar futures, British pound, Canadian dollar, euro, S&P, NASDAQ, Russell, Swiss franc, and Dow futures. These are the only ones we trade. And the reason for that is because these all have micro future contracts available. They're 1/10 the size of the full size contracts, which means from a realistic point of view, most people can afford to actually trade these. I'm going to switch over to my brokers page and take a look at the numbers and margin and tick size for these type of contracts, so you understand the difference in contract size and how we can all trade them or afford to trade them. Some of us can't afford to trade the full size contract. It's not realistic. Okay, so this is my on Schwab, Street Smart Central, and I'm going to go to futures products. So these are all index futures here. These are all the different types of futures available to trade at Schwab. You can click on any of them. It expands the list to all the different types of futures contracts available for trading. I've been trading futures on Schwab since 2006 or 7. So it's gone really, really well. It used to be Options Express. And then Options Express was acquired by Schwab, and then Schwab's acquired by TD Ameritrade. Everyone acquires everyone along the way, but they still exist as separate products, separate entities for trading. So this is Street Smart Central, available at Schwab. I'll just want to take a look at, quickly show you as an example of what it costs to trade, how much money is needed. I'm going to take a look at margin requirements. Futures is what we used to trade, myself and Becky, back in 2006, 7, 8. And what had happened, it used to be it would cost like $3,000, $4,000 margin to trade one NASDAQ contract. But as the price went up, volatility went higher. We were trading Russell futures one day where the margin was $4,500 of margin just to open one contract. And literally overnight, the margin changed to $9,000 per contract just to open one contract overnight. And over time, the margins just went so high, we ended up stopping trading futures because we needed an account that was several times bigger than what we had to be able to do the same trades that we were doing. It got kind of ridiculous. So that's when we started trading Forex, and then because we could trade smaller. But several years ago, all the micro futures came into existence. So that's 1/10 the size of the full size contract. So now we are back to trading futures, which is what we actually really love doing, because the percent return on trades is just excellent. So as an example, the difference in the micro and the full size, here's a NASDAQ. If I open one E-mini NASDAQ contract, I need $14,000 something in my account just to open one contract. That's just to open the contract. That's not even to trade it with the stop loss and everything else. That's just to open a contract. If I wanted to trade 3 contracts with the NASDAQ, I need 3 times 18. Okay, that's what's that, $54,000. $52,000. $53,000 in my account just to open 3 NASDAQ contracts. Okay, so that's requires a much more bigger account than most regular people trading actually have. Okay, and the stop loss on that would be several $1,000s. If you took one loss on one contract, you'd be losing several $1,000s. Because we're swing trading, not day trading. We don't sit in front of a computer all day long, look at little things go up and down. We stopped doing that a long time ago. Okay. But take a look at, we have the option of trading the micro futures, the micro NASDAQ, where the margin is $1,825 as opposed to $18,000. That's the difference. So Most people can't afford to trade the bigger contract, but we can afford to trade 1/10 the size. With the NASDAQ, 1 point is $20 for 1 point, and the micro, it's one point is $2. Okay, if your stop was $100 on, let's say your stop loss was 100 points on the full size contract, that would be 100 times $20 or $2,000 if you took a loss on one contract. With the micro, it'd be $2 times 100 or $200 loss. So here is where the micros give us a big advantage to be able to trade futures with smaller accounts and still be able to have the full benefit of any trading strategy, but with a much smaller account. Today, we're going to be taking a look at one of the currency futures, going to be the Australian dollar, one of my favorite ones to trade. Aussie and Euro are my two favorite currencies to trade because we get absolutely the best results with those, and we'll show you that a little bit later on also. But currency futures, here is the Australian dollar full-size contract. It costs $2,200 and something just to open the contract and just to open the position for one contract of margin. But we have micro futures available and only costs $225 in margin just to open one contract. Okay, that's not what you're risking. That's just money you have to put up to open one contract. So this allows us to trade our futures with any strategy in a much smaller account and get the full benefits and percentage returns. So keep that. So this is why we use the futures and trade with micros. But people who have bigger accounts, you can trade the full size or the E-minis. That's not a problem. But if you have a smaller account, let's say under $50,000, even under $10,000, then the micros are very workable for you. Even under $5,000, you can trade the micros. You can trade one lot, two lots, two contracts. It works with the micros, and you can get in most of your trades and get the full benefits percentage-wise to the size of your account. Doesn't matter if you're trading a $5,000 account, a $20,000 account, a $50,000 account, or $500,000 account. Percent return is percent return. It's the same thing, okay? If you have any questions along the way, please stop and ask me. And you can, if you raise your hand, I probably won't see it, but just go ahead and type it in the chat window or unmute and ask me any question at all along the way. So, but we're going to be focusing on Australian dollar for today's example, and then we might take a look at some euro. All right, I'm going to switch back to this for a second, and then switch back to the presentation. Okay. So one of the strategies we trade is the bear attack. I wanted to do this. This is one we've had for a long, long time. We also traded Forex with this strategy. It's a strategy we use to find short trades after a market's been rallying, okay? And it's been very, very good to us. So how we set up trading plans is just a sample trading plan here, but we usually have a setup, trigger, and trade management terminology we got from Jake Bernstein. The setup is going to be visually what you look for. And here it says, generally speaking, it's going to be a bearish cross in the trigger lines. Two lines crossing down, and we'll go through that in a little more detail. But a bearish cross in the trigger lines. And then trigger is a confirmation. After we see the setup, then we go into more details to confirm the trade with other additional details. And then the rest is trade management. And that we go through. I'll go through one trade today in detail, so you understand it and understand how the numbers work out and percentage returns. But we also, there are a couple of different ways to do trade management, and we go through that when I do one-on-one coaching sessions. But we'll go through one of them in detail today, so you have a feel for it. And if you're comfortable putting together your own chart, this is stuff you can actually do yourself. for people who I'm coaching, I provide all the charts for all the different strategies, and we'll take a look at that a little bit later on. For the Australian dollar, it produces approximately 88% winning trades, okay? And profit or loss is 3 something dollars made to every $1 loss, a 3-to-1 return overall. And that's 3-to-1 means 3 something dollars made for every $1 lost, okay? And with the futures, we can create, this is at the low end. That can be higher depending on how you manage positions beyond the first profit target, but that is doing the minimum amount of work, getting into a position and exiting the whole position at the first target. Okay. Like I said, any questions you have, just let me know and type it in or unmute and ask a question. For this particular symbol, Australian dollar, I listed out, it's in the handout. And if some of you came in late, look to the chat window for the link to the handouts. But we listed all the trades valid on Australian dollar going back to 2003 for this one particular strategy. And we're right at 88% winning trades. And this is the summarized stats for those for the Australian dollar. And you can see why we like Australian dollar. It's a very high win to loss percentage with this strategy. And most of the other strategies which we trade the currency futures, the numbers are fairly comparable. Okay, and I'll show you that a little bit later on also as I go through some of the other strategies as far as the stats go. Okay, so now I'm going to switch to the chart. Unless you have any questions right now, I'm going to switch to the chart and go through a trade in detail. And here's where please pull out a calculator, because I'll be asking you to make some calculations. I'm going to change to the chart. Okay. So what we're looking at right now is a chart of the Australian dollar futures. Okay, so the lines crossing up and down are the trigger lines. Trigger lines are linear regression, is a linear regression line and a moving average of the linear regression line. That's what the trigger lines are. And this chart I would give you, if you're going to be trading the strategies, I will give you all the charts ready to go to use on the platform. Platform we use is NinjaTrader, and you can use whatever platform you want as long as you have access to the indicators, or as long as you can create them on that platform. Otherwise, we use the NinjaTrader platform, which is free to use. And we also use Thinkorswim for charts, but NinjaTrader is what we use for our analysis, not for live trading, but for analysis. It's free and it's a great platform. All right, so let's take a look at, so what we're looking for is when the two lines cross down. That's our setup, okay? You're gonna see all these candles red and all these candles green. It doesn't matter if it's an up day or a down day, there's an indicator that's loaded onto this chart, which will color the candles red or green, giving them a bullish or bearish bias. That's part of the strategy. Okay, so this is a down day, there's an up day, they're both red, doesn't matter. Up day candles are not filled in, down day candles are filled in. This one's green, it's a down day, it's filled in. This one's candle is open, it's an up day. All right, so the indicator we have, the super trend, it will color the candle and give it a bullish or bearish bias. You can color it any colors you want, but we have it set to red and green. And that's regardless of whether it's an up day or a down day. So how we enter short trades and long trades, we only enter a short trade, a bearish trade, if the market is actually going down. Stop. And we only enter a bullish trade. Okay, so we got someone. Let's see who that is. Does someone have something to say? Okay. All right. So if we have this cross down day. Now let's take a look over here on the data box. This is what we're going to be looking at. Everything on the data box color-wise matches what's on the chart. So these two lines, kind of brown and light blue, will match the numbers over here on the data box. When you see all four numbers filled in, that is a day the two lines are crossing. The previous day was not a cross, not a cross, not a cross, not a cross, so all four numbers are not filled in. But on a day it crossed, you'll see all four numbers filled in. That's a quick visual reference. Sometimes it's too tiny, so you can't really tell which day is a crossover day. But so you have to look at the numbers sometimes. And so this line here is plot 1. And when it crosses, and this line is plot 2. So when plot 1 crosses below plot 2, we're in a bearish cross. This is now plot 1. And when plot 1 crosses above plot 2, we're now in a bullish cross. And that flow goes on continuously throughout the, okay? So what we're looking for is a bearish cross where plot 1 crosses below plot 2, and that happens on this day. All right, so let's take a look at the numbers now. What we use are sell stops to get into a trade. A sell stop means we enter the trade when the market goes below a certain level. That's a sell stop to get into a trade. A buy stop means we enter a trade when the market goes above a certain level. That's a buy stop. That gets you into the trade on the long side with a buy stop. And a sell stop gets you into the trade on the short side when the market goes below a certain level. So for this particular trade, the low, take a look at the data box, is 0.6649. And it's 4 decimal places. For these futures, we're looking at that 4th decimal place. Every time it increments by 0.0001, it's going to be worth either $1 or $10, depending on whether you're trading the micro or the full size contract. So if 0.6649 went to 0.6648, it meant it decreased by 1 tick, and it decreased in value by either $1 or by $10, okay? So every tick is going to be worth $10. Excuse me, every tick is going to be worth either $1 or $10. To keep it simple today, we're keeping it based on a micro, so every tick will be $1. Okay. Any questions so far? I'm going to go through this pretty slow to make sure everyone gets it. So the low is 0.6649. Someone tell me, if I want to get in 10 ticks below this low, what number would that be? If 0.6649 is the low, what would 10 ticks below it be? What number would that be? Please type it in. Correct. 0.6639. So for this strategy, I'm entering the trade 10 ticks below the low. So we'll keep that number in mind. Now, the stop loss for this particular trade will be 10 ticks above the highest high in these 2 days, which includes the trade signal day. The day we get a trade signal, we call the signal day. So between this day and this day is going to be 10 ticks above the highest high of these 2 days. That's going to be where our stop loss is. So the high this day is 0.6715, and the high this day is 0.6717, which is higher. So if our stop loss is 10 ticks above this high of 0.6717, what is that number, 10 ticks above the high? Please type it in. 10 ticks above 0.6717. Very good, 0.6727. All right. So now we have to determine our risk. So we're going to calculate how much we're risking on one contract, first and foremost. So what is the difference between our entry and stop loss? How many ticks? So if our stop loss is 0.6727 and our entry is 0.6639, how many ticks difference is that? So that's basically 0.6727 minus 0.6639. How many ticks is that? 0.6727 minus 0.6639. It can't be exactly 90, right? So that's one's a 9 and one's a 7, so it can't be a round number. What's the exact number? Okay, 88. Okay, 88 ticks. Remember, for the micro contracts, one tick is $1. So what I've just calculated tells me that if I take a full loss on this one contract, I will lose $88. Okay, that's what it's telling me. I will lose $88 if I take a full loss on one contract. So you can start seeing how we can trade smaller size accounts with the micro futures. If you have a smaller account, this is perfect. So you can actually learn to trade and build up your account size and then trade bigger as time goes on. All right, so now we know our risk on one contract. I like to do everything based on $1,000. It just makes calculations easier. If we want to risk a total of $1,000 on this trade, how many contracts can we get? So we know it's $88 is the risk on one contract. So to determine how many contracts we can get, we have to divide 1,000 by 88. So what's 1,000 divided by 88? That'll tell us how many contracts we can buy. What's that number? $1,000 divided by 88. Okay, about 11. Okay, 11. So we know we're going to buy 11 contracts. We have to round off since we can't get partial contracts, so 11. Okay, so we now know we're going to buy, we want to risk $1,000. About, it's never going to be exactly. It's going to be plus or minus a little bit, but so if you're going to risk $1,000, realistically, it's going to be somewhere between 900 and 1,100. It's going to be in that range, realistically. So, but we've calculated, okay, we want to risk $1,000. So that allows us to get 11 contracts. Great. How this works now, we have to have a profit objective, and how we do this is the profit objective is going to be a percentage of the stop loss. And what we do is calculate what the percentage wins would be if we have a first profit target that's 40% of the stop loss, 45% and 50% of the stop loss. The bigger you try to make your first profit objective, the less likely it will get there before being stopped out. Okay, so there's a fine line between making money trading, especially in futures, and not making money, because you got to know your numbers, you got to know your stats. Otherwise you can't trade with an expectation of making money. You can make up stuff in your own head and just say, yeah, I'm going to put this target in. Based on what? Why do you think it's going to get there? It might get there 20% of the time, 40% of the time. So unless you have all the numbers in front of you to validate that, you can't just make stuff up and hope to have any consistency. Otherwise, you're going to have some wins, you're going to have some losses, some wins, some losses. But if there's no plan, this is a business. You got to have a plan in place to actually know you're going to make money consistently, no matter what the market conditions are. You know, as long as you keep executing your plan, you're going to come out okay and not just winging it. So, and I'll show you, we'll go through that a little bit later on, but we know how big our stop loss is. What is 40% of the stop loss, which is the stop loss is 88 ticks. What's 40% of that? That's going to be the lowest potential profit. So what's 40% of 88? Okay, 35. So our first profit target will be, we'll make it 35 ticks. All right. And so let's say we have placed this trade and we are risking, we have 11 contracts. What's 11 times $88? Type it in, $88 times 11. $968, okay. Total risk on the trade, $968. Okay, and we know that 35 is 40% of the 88, right? Now, what is 35 times, if we hit at, okay, so our first target is 35 ticks or $35 times 11 contracts is how much? Let's say you get out the entire position, the first target. You have 11 contracts, all making you $35. Okay, $385, okay. What is 385 divided by 968? It better be like 40%. 40%. This is how we get a minimum 40% return at the first profit target. Okay. Now let's take a look at the chart now. When we place this order, this is what it's going to look like on the day we get a trade signal. We're going to fire up our trading platform, our analysis platform after the market closes, after 2 p.m. Pacific time. After 2 p.m. Pacific time, this is all end of day data. This is not moving in real time. This is end of day data. We're not day traders. End of day data after 2 p.m. Pacific time. This is what we'll see for this day. We'll see the two lines cross down. We have, hey, we have a trade signal. The candle is red. You go through the trigger criteria, make sure everything else is valid. And then you look at the stats and you're going to see Aussie dollars, 88% winning trades if I take this trade and it gets filled. Okay. So I calculate how big my stop is. I calculate how big my first target is. And I know my entry is 10 ticks below this low. So what I do, and I want to risk $1,000. So I know I have 11 contracts. I know my entry. I know my first target. I know my stop loss. And we literally have more information available to us set up than probably 90-something% of futures traders. I'm not even joking about that. You got everything set to just place this trade all in one entry. You're going to place an order to sell stop 11 contracts at 0.8639. And when that order fills, that one order fills, and it triggers an OCO order. So when the initial order fills, market goes down and the order fills, it triggers the one cancels other bracket order, which has a target and stop. And I want OCO order will have a target of whatever we calculated and a stop loss of what we calculated. So our target is going to be 35 ticks below the entry. Someone calculate that for me, please. The entry is 0.6639. What is 0.0035 subtracted from 0.6639? So 0.6639 minus 0.0035. 0.6639 minus 0.0035. 0.6604. Thank you, Olga. So that will be our first profit target. Okay. So we enter in one order form filled out, sell stop, 11 contracts, 1 triggers 2, and the 2 orders it triggers will be an OCO bracket order, where after the initial order is filled to get into the trade, to get into those short contracts, then that will automatically create a target and a stop loss. The target will be the 0.6604, and the stop loss will be whatever we calculated previously as a stop loss. And when one of those is hit, the other one will be canceled. Okay. And we know once we have that trade filled, we have an 88% of the times it will be a winning trade, going back to 2003. So, and we give the order 2 days to fill. So this order, the low this day is 0.6649, the entry is 0.6639. The next day, the low was only 0.6659, so the order is not filled. There's nothing to do here. Once you fill once you spend your 5 minutes getting everything reviewed and order filled, you go live your life. This order has 2 days to fill. 2 days later, the low was 0.6636. The order filled at 0.6639. You're now in the trade. You're now in the trade. You didn't do anything. You're in the trade, and your target and stop loss are all set. There is nothing for you to do except wait for either the target or stop loss to be hit. There's nothing to do whatsoever. Okay? You just wait, go live your life, do whatever, go to work, you got family, friends, go to the gym, whatever it might be. This is not day trading. There's no sitting in front of the computer for hours and hours and hours. This is all swing trading. And the low this day was 0.6639. The low this day was 0.6611. So the target's still not hit, not hit, not hit, not hit. On this day, the low was 0.6536. So sometime on this day, the first target was hit. And we locked in our profit. We made our $385. Okay, we got our 40% return on the trade if you're just totally out of the position. If you want more returns, then that means you have to trail a stop loss and do more trade management, or you just take your 40% and move on. Could you put together the OCO terminology, please? One cancels other means when one trade executes, the other one's canceled. So you have a bracket order where one side of the bracket is your target and one side is your stop loss. So when one executes, the other one gets canceled. If the stop loss is reached first, so if the price went up, hit my stop loss, then the target order would be canceled. If the price goes down first, hits my target first, then the stop loss order is canceled. That's all OCO is. It's a bracket order. So when one side executes, the other side gets canceled. But you put all that in one order. This way you don't have to do anything. You let the platform do your work for you. You've done your analysis, you verified it's all good. One is a limit order. A limit order, a target is your target is the limit order. So Olga, yes, the target is a limit order and the stop loss is a stop loss. When the stop loss is hit, you're out of market. The target's a limit order, which you set, which is going to be that 0.6. Your target would be the 0.6604, which you calculated. That would be your target that's hit sometime on this day. That's a limit order. And the stop loss would be just a stop loss, which is a market order that gets you out if it's going the wrong way. Okay. So now it comes down to a math thing. It's literally if your minimum returns a 40% return. So we're going to go through a table that kind of shows you the kind of percent returns we expect on our trades and how the numbers add up. And that's doing the minimum amount of work, not even with profit maximizing and trailing stops. That's up to you if you want to do that. But if you want to do just the minimum work, you put in your entry, target, and stop and walk away, then every win is going to be at least a 40-something to 50% return on the amount of money you're risking. And when we're at 80-something% wins, it's just a matter of being consistent with your trading. And the numbers just add up. And this is a strategy that kind of happens over and over again. Here it wouldn't be valid because it crossed down, the candle was green. Not valid, crossed down, the candle was green. Not valid. If you took this trade, it'd be a loss. Not valid. Here, cross down, really good trade. Here, cross down, good trade. Is going to be hit the first target. The short trade, not a big range. 40% of this range is going to be hit pretty quickly. Here, order not filled. It crossed down, but note that if you put in a sell stop, it never went lower, so no order got filled. So there's nothing. Here, cross down. Your stop loss is up here. So when you get into the order, it goes against you for about a week and then drops. But since your stop loss is above this high of these 2 days, it never gets hit. So you just got to be patient. You just put your trade in, and 2 weeks later, you get paid. Maybe, let's see, put your trade in here, valid trade date, enter the trade here, and you go 1, 2, 3, 4, 5, 6, 7, 8, 9, probably 10 days later, 2 weeks later, your order's getting, your first target's getting hit, doing nothing. Once you place your order, walk away. There's nothing to do. Easy trading. Cross down with the green candle, so you have nothing. Cross down. Here it is. Nice trade right off the bat. Target's going to be hit within 2 days. Okay. So this is pretty much how we trade this strategy. And a lot of our strategies are basically like that. We have multiple strategies for trading shorts after the market's been rallying. We focus on trading shorts after the market's been rallying. And we have several strategies for trading short, for trading long trades after the market's been decreasing, and several for in the middle. How long do we wait for it to execute? Almost all of our trades, Olga, the entry has to happen within 2 days from when the trade signal is valid. So for pretty much all of our futures trades, pretty much all of them, there might be one index future that has to happen the next day, but otherwise they all have to fill within 2 days. Once you're filled, you're going to be in it for as long as it takes. If it takes 3 hours to reach the first target, it takes 3 hours. If it takes 3 weeks, it takes 3 weeks. But realistically, most of the futures trades take anywhere from 1 to 2 days to 1 to 2 weeks, realistically. So the money turns over faster, realistically. All right, so are there any questions so far on anything? Feel free to unmute and ask questions or type it in. All right, so I'm going to switch over to a spreadsheet I asked Becky to put together, so it gives you a feel for how money is made and how it adds up, and the reality of trading, swing trading our strategies. And I'm going to switch to share. Remember, ask any questions you want. Futures. Okay. All right. Some of you have seen this before, but it's a way we use our can this strategy be automated? It can be automated in the sense that you can write something to find the opportunities. However, this is swing trading, and it's automated in the sense that you take the 2 minutes it takes to fill out your order form and walk away. So I'm not really sure how much more automated you want beyond that. You literally have to fill the order form out and walk away. Because you have to make a decision if a trade is valid. It doesn't just magically make itself valid. You have to evaluate the criteria as a human being to make sure everything is valid. I don't know any way to automate doing 5 minutes worth of work. You do have to, human being has to be involved to review this, make sure it's valid, make sure it fits the criteria, the statistics, every detail is valid. And some of the details is the candle red or whatever color it has to be. So did certain things happen within a certain given time, but it is automated. You're filling out the order form that takes 2 minutes, push the button and walk away. So it is automated. And you can write something to find the opportunity to find the crosses. So that is something to automate. If you know how to do that, then you write something to find, oh, these 2 lines cross. So that would just mean you are turning, push a button, runs a scan on all the different symbols to find the 2 lines crossing. But it takes me, let's say, okay, let's do this realistically now. I'm going to look at 5 symbols, 6S, Swiss franc. I'm looking at Friday, this past Friday. Did the lines cross bearish on Friday? No, nothing to look at. Did the lines euro? Did the lines cross bearish on Friday? No, they did not cross bearish on Friday. Did the line euro, Canadian dollar, did the lines cross bearish on Friday? No. British pound, did the lines cross bearish on Friday? No. Aussie dollar, did the lines cross bearish on Friday? No. So we have no valid trades this past Friday on. I just looked at one strategy and 4 symbols. It took me about 10-15 seconds. So that's all. It really doesn't, not that big a deal because it's so visual. I'm just looking for 2 lines crossing down. If I don't see the 2 lines crossing down, there's nothing to do with that particular strategy with those symbols. Just 5 symbols we're looking at. So it goes really fast. And once you get into a routine of doing this, I do my futures review probably in 7 to 10 minutes. And that's reviewing about 10 different strategies in about 7 to 10 minutes, because all I'm doing is looking for 2 lines crossing. So after about a month of doing the strategies on a regular basis and looking at them each day, it becomes like second nature. It goes by really, really fast. Because all you're literally looking for are 2 lines crossing or 1 line hooking up or hooking down. And so it just goes really fast. But it literally what I just did, that's how long it takes me to do that review. If I see a cross, if I was just doing a quick review and I saw this happen, if I saw this on the day I'm doing a quick review, then I have to stop, make sure everything else is valid, place my trade. Otherwise, nothing to do. So when you go through all of this, you might find 1, 2, or 3 trades valid for the day. So you got to spend time on them after to go through in detail and verify everything's actually valid, all the detailed criteria. But yeah, you can write a scan if you know how to do it. All right, so let's take a look at, you probably couldn't see what it was on the chart. I hadn't shared the chart. All right, so let's go back to here. This is from, I asked Becky to put this together to give for the last couple of years, just to give people a feel for how money is made and lost and what to expect when trading realistically. If you're looking for trades every day, that ain't going to happen. This is swing trading. And in most of our strategies, to get a sell signal, the market has to go up first. To get a buy signal, the market has to go down first. So you only get, we get trade signals at basically tops and bottoms of markets. That's how we choose to really get the best bang for our buck, is buying the bottoms and shorting the tops. Those are how we get our best returns. So our strategies kind of are always looking for where markets are turning up or rolling over, coming down. That's how we're always looking for trades. Are markets rolling over? What strategies do we have to pick up on that? And are markets turning up? What strategies do we have to pick up on that? And how we have strategies, myself and Becky have literally traveled all around the country, learned from people from all around the world, from whether it's from Australia, Europe, and we literally went to people all around literally we travel to, whether it's Florida or Utah or Oregon or wherever it's be, Las Vegas, where we learn from people who trade their own real money. And that was a big difference from learning from trading schools. Trading schools focus on selling you classes, but the people, so you have to differentiate, are these people just showing you a course, or do they actually trade? So you have to kind of differentiate that. But the people who are trading their own real money, it makes a really big difference, really big difference of how they do risk management. And Olga asked, do you use Excel spreadsheets to calculate entry, stops, targets? Becky does. Becky does all of that on spreadsheets. I don't. As some of you have already seen in the past, I have a sheet of paper here. These are all my futures trades. I just write it out, what I'm going to be trading and when, and my targets and stops. It takes me seconds. It would take me like 10 times as long to type it into a spreadsheet, so I'm not going to do it. I don't type. I'm not a typist. I hate typing. So I will not type stuff. It takes me like literally T1, T2, entry, target, stop, calculate, done. But I'm not going to sit down a spreadsheet. Other people really like spreadsheeting. Great. I know some people I work with, they have a old school logbook, you know, the binder, the solid binder. They open it and they document the trade, just write it down. And that's great. You want to write stuff down somehow because you will need the information at some point in time. It's good to write it down. But if you can, if you're into spreadsheets, great. If you're not into spreadsheets, calculator, pen and paper, no problem. Let's take a look at this. 2019, in the month of January, 5 valid trades. Okay. The number you're seeing here, if you see, this is all based upon a $50,000 account, okay, based on a 50 grand account, where we're risking $1,000 per trade, which is 2% of the account. So everything we do here is showing you is all skewed to $1,000 risk and what the percent return would look like. Doesn't matter if you have a 50 grand account, a 5 grand account, a 10 grand account, $100,000 account, or a $500,000 account, the percent return would be the same. Okay, percent return is the same. For calculation purposes, we did it all based on a $50,000 account and $1,000 per trade being risked. We know it won't be exactly 1,000; it'll be above or below, but $1,000. If you see 429, that's a 42% return. You see 344, the 34% return. All right, based upon that particular strategy. Percentage return. So let's take a look at this here now. There's only first target. This is not trailing stops. It's just first target, all in, all out. If you took all 5 trades this month, you're down 1.something% for the month. The next month, first targets only. This is our profit and loss for that month. The next month, March, 5 trades valid, all wins. That's our dollars made and percentage return on the account for the month. Okay, this is all based on a 50 grand account. Now, let's say you had a $5,000 account, 1/10 the size. This would be $208 profit for the month. This would be $119 for the month. This would be $80 loss for the month if you had a 5 grand account. Okay, the percent return stays the same. If you had if you were trading a $100,000 account, this would be $2,400 made. This would be $4,160 something made. For the 100 grand account, it's all percentage return. Okay. 2% is an ideal percentage return or percentage risk. If I'll show you some other scenarios later on, but 2% risk per trade is ideal. You can never have a big loss. You can never, ever have a big loss. if you're only risking a certain set amount each trade. And Olga asked the question, how do I do it without decimal points? You have to, I can't help you with spreadsheet stuff. So that you have to learn from spreadsheet people who can help you with decimal points. And because if you're going to do that in a spreadsheet, you need to know how to set that up, because different different futures have each tick is worth different amounts of dollars. So
I just meant that to do it that fast, you do it without the decimal points.
Oh, I just know that I just do it with ticks. I don't even think about decimal points. I just think if it's I
that's
just
what
think,
I meant.
I don't even think decimal points. I don't think about the decimal point at all. Even when I'm doing calculations, I just type in like the whole number. It's just the same thing. But that's because I'm just used to doing it so much, it just flows for me. But the more you do, it just becomes easy, and decimal point just kind of goes away. All right, so let's keep going through this for a couple of months. And this is one of those really nice months where you got a nice 8% return for the month. Okay, so you see the monthly returns here. Realistically, you're going to expect to have 3 losing months a year. In most cases, you're going to have 3 losing months a year. Those 3 losing months will be offset by 3 winning months. That means the other 6 months is profit. That's why you can have a scenario where you have 3 winning months in a row, and you're like, yeah, best year ever. And then you have 3 losing months in a row, and you're like crushed because you've given back all your money, you've made nothing. It's been 6 months of trading, and you're flat. You got nothing. Get used to that. That's just normal trading. You have to keep trading through 12 full months to see the full results. Okay, so Gloria is asking a question. Okay, Gloria, I might have missed this, but what is the average annual returns you have been seeing on? Well, that's what we're going through now, Gloria. We're starting on like 2019 to show you the returns. So these are all the monthly returns. This is July, August, September. October is always a big month. A lot of trades in October. Note, like almost all of these are long. This is normal for October. When we see buy signals in October, cha-ching. October is a great month for long trades, 12% return. So if you see buy signals in October, that's usually great. The seasonal pattern. As we get through 2019, that's a 46% return on the account for the year. 23,000 made on a 50 grand account. If this was a $5,000 account, this would be $2,334. This was $100,000. This account, this would be $46,000 made. Okay, that's taking all the trades in a very structured way with first targets only and walking away. It is not. If you trail stops, there are opportunities to make more money. If you take part of your position off of the first target and manage the rest of the position, there are opportunities to make more. But this is doing the minimum amount of work. And realistically, most people just take the first target because it's an easy way to trade, because we don't have to keep track of multiple positions going on at the same time and which contract goes with which. It's just an easy way to trade. You just put your order in and walk away. It'll either be a loss or it'll be a win. You got 2 choices. One will happen or the other. Okay. 2020. January. We had 1, 2, 3, 4, 5, 6, 7, 8, 9. This is return for January. We have losses. We had a 1.6% return. This is an example here also of you can't just wing it. If you pick up 1 extra loss because you did something random and arbitrary, you have now gone from making money that month to losing money that month. 1 or 2 bad choices that are just arbitrary, just like speculating, or you change your risk from $1,000 a contract, or you took 1 trade, you were so sure about it, you heard everything, it's going to be, this is the next big thing, and you take a trade where you risk maybe $3,000 to $4,000 because you knew it was going to be a winner, and that'll be the loss. And now it skews everything, because how do you make back? You now generated several months worth of losses in 1 month because you went off plan. Okay. You stick with your plan, you stick with your methodology, and the numbers work themselves out. Okay. So next month, remember, this is the month when things started shutting down. February and March 2020 were some of our best trading months, actually. And it's just a matter of following the plan, not speculating, not listening to what you hear on TV, on the news. This is just going with your objective buy and trade sell signals. If there's something really bad happening in the news and it's going to impact the markets, guess what? It's going to create a sell signal, which at that point in time, now we know when to get in. We know at what price, we know our risk, we know our stop, we know how many times, we have all the details. If something is happening in the news, whatever it might be, economic announcements, whatever it might be, at the end of the day, it will create a buy signal. When it creates that buy signal, then we get in, not randomly just guessing. And you don't want to speculate with futures. Futures can wipe out your account fast. There is no speculating with futures. Futures, end of each day, the money's either there or it's not. And you make a mistake with futures, you can owe your broker money. So when you trade futures, always have your risk management in place. Always have a stop loss. The one day you trade with no stop loss will be the one day the market goes crazy and goes the other way and against your position and wipes you out. So that's why when I teach futures, you got to have your stop loss on every single trade. Even if you make a mistake, as long as your stop loss is in place, it will save you and save your capital for the next trade. Because you always have to have your capital for that next trade. Okay, so we're going 2020. We're into April, another good month. May, remember, I had a great 2020, and one reason is because even better, you see what my 2020 was looking like win-wise. When everything shut down in 2020, I'm someone who has several streams of income. I make money doing this, I make money doing that, I make money doing all these different things. When things shut down in 2020, my only stream of income was trading. This is the only income I had that wasn't cut off. And it just got better because the more volatility that came into the market actually was better for us. But this was the only income, real income I had trading was trading. And my numbers look like this. I focus on my trading. Plus the options, not just this, but plus options also. So it was really, really good for me. Okay, we're getting through 2020. It's just been a great year of trading. You can take a look at the numbers. And you can take a video later on. You can even slow it down, take a look at it. For the end of the year, 60% return on the account. 60% return on a 50 grand account was $30,000. If you're trading a $5,000 account, it'd be $3,000. If you're trading a $500,000 account, it would be $300,000. Percentage return, doesn't matter how big the account is, it's percentage return, okay? So now we're into 2021. Starting out the year really, really good. And sometimes this happens, you get, no matter what methodology you trade, at some point in time, you are guaranteed beyond any of a shadow of a doubt to get 4 to 6 losses in a row. It will happen. That is why you can't take big risk in your account on one trade, because eventually you will have 4 to 6 losses in a row. Back in the day when we started, we'd be like, hey, we have 90% winning trades. Let's risk 20-something% of the account on one trade, 20% on discount, because we're not going to take a loss. It's like 90-something% wins. All of a sudden, you get 1 loss, that's 20% of your account gone, 2 losses, 40% of your account gone, 3 losses, 60% of your account gone. You can't recover from that. 2% account risk per trade. If you trade taking fewer trades, then there can be a little bit more, but generally speaking, we trade in a very structured manner, is what I teach, 2% account risk, and you can't wipe out your account. You can't get damaged. beyond the point where you can quickly recover. All right, so going through the end of the year, good trading all the way through September, October. Once again, October, really good. My favorite month of trading is October usually. So end of the year, 54% return on the account. And you can do, if it was 10, once again, if it was a $5,000 account, it'd be 1/10 this number, so on and so forth. You can do the relative math, but that's just once again, structured trading following the plan. And we like to lay these strategies out, because you may not want to trade every single strategy, but when you have information available to you and you put it into a spreadsheet format like that, you might see one strategy that you don't really, you might look at it as like, yeah, maybe I'll take this one out and see how the big picture looks if I wasn't trading this one. But generally speaking, they're all over 80%. But sometimes just certain strategies give you a bad feel. Even though you know it's still 80-something%, you just don't feel good about it. Pull it out. That's okay. You got a question from James. Are these strategies purely numbers based, or are those cases where researching quantitative data like in the news would help? You can't, we don't do subjective stuff. Looking at news, people can have 10 different opinions on what they see in the news. That means nothing. So everything we do is 100% objective when it comes to futures. There is no speculating. There is no looking at news. Although if you see sell signals and you see awful news going on, you go like, yay, okay? Quietly, yay, because you get sell signals combined with bad news. You're pretty sure your trades are going to go really well on the short side. Or if you see buy signals with really good economic news coming out, the president's going, yay, everything is great, and everyone's saying, yeah, we're gonna, everyone. And then you get buy signals even better. But it is not a decision maker as far as what to trade, when to trade, how to trade. It just makes you feel good after you see a valid trade that just happens to match up with the news. So it's good to watch the news, but don't make decisions based on the news. Wait for your good buy and sell signals. That is what you really want to do. So we're in 2022 now. 2022 was a tough year trading. The currency futures did really well. Index futures came out a little bit negative, but overall, so we had a losing month there, slight losing month. You will always have losses in a row. Here were 5 in this month. There were 1, 2, 3, 4 losses in a row, which negated previous wins. And you have to put this out of your mind and keep trading. Now, here's something to think about. Let's say someone became one of my coaching clients at the beginning of March, and they started trading these strategies. And then they started their first trade on the 7th. They got, yeah, I got to win. Yeah, I got to win. And then they got a loss and a loss and a loss and a loss and a loss. How many of you would keep trading that strategy with some guy you just met online, and all you know from him is that these strategies he taught you have done nothing but lose you money since you started? That is the problem up here. That is why I always want people to understand the big picture, because a lot of this is if you try to live in the moment where you're just seeing loss, 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 psychologically, it's soul crushing. It's really tough to keep trading, because this is where I have to actually talk to people and talk them into continuing trading. I know we have at least 1 or 2 people who've gone through the losses and they're still trading. They're on the meetup right now because they understand the big picture. And they understand losses will happen. You have to trade through that to get to the next side. But when you're new and you start out, if you happen to be the one starting out here and all you saw were losses, and that does happen. I've had people like call me, it's like, I'm just doing nothing but losing money. I stopped trading. Or they'll contact me months later and tell me, yeah, we stopped trading that thing long ago because we did nothing but saw losses. And I'll be like, Yeah, there were losses there. What about the next month? Oh, we didn't look at that. What about the next month? Oh, we didn't look at that either. Yeah, because you can't focus on what's right in front of you. You have to understand the big picture and the consistency. That's how we make money. But yes, some people will start right here. I know some people who did last year. They started right here, got a bunch of losses, and they were like, we're done. We're not trading this. Your strategies suck. But that's when I have to you have to understand, pull this up, big picture, big picture, big picture. You got to trust, keep trading. Even if you trade smaller size, keep trading, because you have to go through this to learn it. You have to experience it. You have to feel it, but you have to go through it to get to the other side. So you get through an awful March where you're down, but now you go to April. Yay, you just made your money back. You go like, oh, okay, well, I'm back even again. It's like that. And then keep going on. You got another bad month of June, a couple of bad months, but that's the way it is. Index futures were not the winners last year, but the currency futures were. But as long as you keep getting offsetting wins, be consistent. Yeah, you're going to get losses, but you got to keep trading to get offsetting wins. Remember, this is maximum loss. These are not maximum profits. These are the minimum profits. Okay, wins can be bigger, losses cannot. Your losses are set, fixed, predetermined. You can't have a bigger loss than this. However, your wins can be bigger, because if we choose to trail stops and sell part of your position at the first target and trail stops to maximize profits, every single win you see here can be bigger. Okay, we put this as worst case scenario if we just stick all out, all in, all out. But losses can't be bigger, but wins can be bigger. So this is really worst case scenario. That's how myself and Becky like to look at stuff. The worst case scenario. So if you keep trading, once again, October, nice month for October, a lot of trades, good profitable month. As the year finishes out, it's up 7% for the year overall. Not the big 60% like we saw previous years, but profitable. And we also broke this down by currency only. So if we were trading currencies only for like 2023, excuse me, 2022, it was a 16% return on just the currencies. So we break everything down by just the currencies and by index only. So this one spreadsheet is everything, but we also broke it down by. So we like to see what's working, does anything need to be tweaked along the way. So this is an ongoing process, but we like to see if we can. I'm always looking how we can improve our strategy. So there's always little tweaks going on with some of these strategies. It's not just to make them. They might make it more profitable. There are ways to make things more profitable, different trade management, position management to make them more profitable. I'm always looking at it. I know probably 20, 30 something different ways to take profit and trail stops. So I'm always looking at different ways. How can we apply a different methodology on the same strategy to get more profit out of it? That's an ongoing thing for me. Okay, this is 2023. Good January, February, March. Couple of basically April was break even. May was a small loss percentage wise, and we're into May and we have several trades already open, which we already know are well on its way to the first target, currently open, especially on the long side. We have several trades long on index futures currently in progress and heading to the first target. For the year overall, up 8% for the year so far. All right. But like I said, this is how we trade and how we track, and we have all this that goes back to 2003 for all of our futures. So we track all strategies all the way going back to 2003. I'm going to go back to, do we have any questions on this before I go back to the handout or chart, or is there anything you want to look at? I'm going to give you a good overview of what we do. If you want the details on the indicators for the trigger line, just email me. I can get you those details. If you want to try to recreate it yourself, that's fine. And if you are working with me on the coaching, then that is, I have no idea what the best year is. In the last couple of years, I think that if we look, 2020 was my, that's it, 2020, Olga, 2020 was my best year of trading. I don't even look at that. 2020 was my single best year of trading. That goes hands down, 2020. Don't look at any numbers. I think part of that was also because I was so focused. I was personally, all my energy was on trading because that was my only income. So that was my single best year of trading was 2020, hands down, no question about it. I have no idea what the worst year is because I don't have worst years. There are no worst years. Worst years might have been when I started out trading in the learning process, probably sometime between 2005 and 2008 in that learning process. And where we made bad decisions. It wasn't because we made bad trades. It was because the first year or two we started trading was 2005 and 6. We were learning purely from educational organizations, and they didn't tell us anything about trade sizing. All they told us was, when we get the 3 green arrows, go long. When we get the 3 red arrows, go short or get out of the long. And for those of you who know the 3 red arrow and 3 green arrows companies, they no longer exist. But that was an educational organization. Myself and Becky paid $3,000 to take that class. And what we found out is that they held back information because what they wanted you to do is experience loss and then decide that you really need to buy the $20,000 package to get the real information. That was their sales, that was their plan. They didn't give you all the information you needed to be successful. I learned that along the way. But the worst year had to be between 2005 and 2007 when we were learning, burned through thousands and thousands of dollars in the learning process, thousands of dollars burned through it. You know, I go to work and I gotta send money to Extra Options Express to put money back in my account, but that was just a learning curve. We learned new option strategies and didn't learn all the trade management needed. Learn future strategies, but once again, once we got to learning from people who trade their own real money, that was basically John Carter, Hubert Centers, and Daniel Gramza, Jake Bernstein, and a few other people, then we haven't really had any losing years. Some years are better than others, but the worst years came when we were just focusing on stuff we learned from educational organizations. The real learning to trade came from when we started learning from people who traded their own real money. Big difference, big difference. Because they would even, when we go to certain shows, what I found out to do, if I go to the Traders Expo or Money Show or any place, I would try to catch the presenter off to the side, away from the presentation, and ask him or her straight up, is what you're presenting stuff you actually trade in real life, or is what you're presenting stuff you were paid to talk about? And in most cases, it was what you were paid to talk about, realistically. And I asked them, what do you actually trade? Because you talked about doing this double diagonal butterfly, this and that on options. And I asked them, well, what do you personally trade in real life? And they're like, well, we have a portfolio of stocks and we just trade covered calls. That's what they do in real life. But they have book knowledge. So they get paid to talk about stuff that they have knowledge of, but they don't actually do. There's one person who was actually in charge of futures at a major brokerage. I won't say which brokerage and I won't say his name, but he was literally too afraid to trade himself. he can tell you everything about trading, but he won't trade himself, just too afraid to trade. He just won't do it. So I'll talk about Eddie, I'll talk about that in a second. So it's interesting when you talk to people at conventions or trading conventions, always prefer to catch them away from the crowd and ask real questions. Ask the question you don't want to embarrass them with in front of the group. Well, do you really trade this? That's embarrassing. Catch them all to the side and it's like, dude, do you really trade this yourself, or do you just, and they will tell you, they'll be brutally honest, they'll tell you. But you find the people who trade their own real money, and that's who you learn from, because it makes a big difference. I'm going to switch back to the presentation and then answer Eddie's question. Let's see, share. Let's see, futures. Before that, this is a presentation, I want to show you just a little snapshot of some of the strategies, this quick snapshot. This is a quick example of some of the strategies we trade with futures. T-Hook index futures buy. If you see it in light blue, it means that particular symbol, ES, NQ, or TY, is 80% or higher in win rate. Now, if you see 80% or higher, it means it'll show up on our list of valid trades. However, some people might only want to trade something that's 84% or higher to give themselves more cushion. Some people only trade 85% or higher. That's okay. But 80% is our minimum. At 75% wins, we make money. At 80% wins, we make good money. At 84% wins, we make a lot of money. At 84% wins, we're making 2 times what we're losing, basically, at 84% wins. Okay, so once you have the numbers in front of you, then you can decide what your personal cutoff point is. You might say, I'm not going to trade anything under 83%. So that's why we wouldn't be trading the ES if it becomes valid, but we'd be trading the Russell or the YM, the Dow, if it became valid. So you set your own line. These are some other strategies which we trade actively. These are all current actual win-loss stats as of last month. These are all, like I said, these are all stuff we currently actively trade. And these are the current win-loss stats for things we actively trade. Once again, if we saw the Swiss franc valid on this strategy, we would pass on it because it's too low. Okay. But if we saw the Swiss franc valid on, or if we saw the Canadian dollar valid on this strategy, trade it. If we saw British pound valid on this strategy, trade it. Okay. All right. So the question, might have missed this, but how are the success rates calculated and how consistent are they? We constantly update this every month. So for the success rates, that's an ongoing thing. If it's Becky updates the win-loss stats every single month, and we send out updated stats to our trading coaching clients every 3 to 4 months. So if something drops below 80%, you'll know about it because you'll see the updated trading plan and stats. Even below 80%, we're still winning. We're still making money, but we want to have a little bit of cushion. But the stats are updated based on real trades and based upon it's an ongoing process. So if we have an extra, like right now, there's a YM trade in progress, I think 2 of them. At the end of the month, Becky will look back with those 2 YM trades, wins or losses, and update the stats accordingly. And for those particular strategies, the percentage will either go up or down based upon whether they were wins or losses. And they're pretty consistent. We don't, realistically, the stats only fluctuate maybe plus or minus 2% realistically. It would take 2 or 3 losses on one symbol consecutive. We don't have that many consecutive losses on one symbol on one strategy. So the stats stay pretty consistent. And that's what we look for also, consistency. But as long as we are over 80%, we're making money, as long as we're consistent trading it. And that's what the most important thing is, be consistent. That's how we make our money. I'm going to switch back to the okay. So
Oh, Lay.
Yep.
Yeah. I remember we had a discussion last week around rollover Thursday.
Yeah.
I just sort of piggyback off you saying that there were two YM trades that are still open.
Those are the ones you were talking about.
Yeah, in the email, right.
Yeah.
Okay, and maybe then anyway, basically it was around rollover Thursday that I had the concern, because basically I wanted to roll out on rollover Thursday, which was last Thursday, and I didn't know what to do because my targets, like my first target for one of the YM trades was 34,100, and it on the June futures contracts, which were they hadn't hit that target yet. It was like way behind that. But on the September contracts, they had already rolled past that first target.
Yep.
And I was wondering how one rolls into that when the first target is already hit.
Okay, so let's take a look at the chart right now. This would have been the numbers before the market closed on Thursday. This would have been the numbers starting after the close on Thursday. So what was your target for the YM?
Well, for one of the YM trades, because I had two, was 34,100. So it hadn't been hit.
So that didn't happen until the September contract.
Yeah, but yeah, the September contract rolled way past that.
The September contract opened at 33843. The June contract closed at 33865, and the September contract, this date, opened at 33843. By the time you will look, did you look at the live charts to see that it had already gone up?
Yeah, I looked at them. I looked at the live charts, and there was hundreds of dollars of difference in on rollover Thursday.
Yeah, there can't be, because when you close this position, whatever profit or loss you had at that moment in time is locked in, right?
Yeah, I just locked in because I didn't know how to roll into the next.
So then you open a new trade on this day, and that basically starts from zero. So when you open the trade, it can't be negative. It has to be from zero, right?
Yeah, but my concern was because I was on Thinkorswim, and I would compare the two charts, and
okay, number one, you're looking at Thinkorswim. Oh, you're on a daily chart or intraday?
I was looking at intraday.
Don't do that. Do not do that. It will just mess you up. Look at a daily chart. That's all we care about, the daily chart. And if you look at Thinkorswim, it will open at one price. Don't deal with intraday charts. It will just screw you up.
Oh, I'm confused. Why? Could you explain that again?
Because we're not day traders, and the futures data on Thinkorswim is not all you think it should be.
It isn't.
No, it's not. So you got to look at daily charts. So you have to look at a daily chart and see where the YM opened on the daily chart on Thinkorswim. If you open your Thinkorswim right now, what's the opening price on Friday? That is when the new contract kicked in. The new contract opened at 3 p.m. Thursday afternoon, which is the Friday candle. So if looking at Thinkorswim right now, what's your opening price on Thinkorswim on Friday?
It would take me a while to launch Thinkorswim right now.
Yeah, Olga is saying toss didn't roll into September yet. But it should have, because they couldn't trade on Friday if it didn't. Yeah, so the opening, so what time were you looking at it on Friday? I mean, on Thursday afternoon?
It was I think it was after we had our discussion, which was probably about 8 something PM.
Yeah, so the market could have either gone up or down. I'm not sure where it was at that point in time. So depending on where you got in, it could, but when did you enter the trade? When did you actually roll it? Because we talked about 7:15 is when we talked, about 7:15, 7:30 is when we talked.
Well, I didn't actually roll it. I just got all the way out because I didn't know what to do when I saw the
Okay,
discrepancy.
so yes, based upon the June contract, and where you got in the June contract, yeah, you might have taken a loss because you just got out.
Yeah, I only got out. I didn't roll in.
Yeah, so when you roll into the new contract, it starts from 0, and then it would have gone up to your first target. And it would have made back the money that you had lost from getting out.
Well, I see, but
So you would have lost money when you exited the original position, but then you got into the equivalent new price, and as it goes up, you make that money back.
yeah, I'm a little confused on that. I guess this will be
so that's why you want to do the roll in one transaction, so it takes that thought process out, because you would get out. Let's say you got out here, you'd be getting into the new contract here, it just goes up and make your money back. So you might take a small loss on the June as you roll out of it, but then you make the money back as it goes up to you on the September contract.
But you said it earlier that these YM trades were still alive.
No, because I was just talking about what you were talking about. I didn't look at what you were doing. I've been going by what you said.
I see.
Yeah.
Oh, okay. Because it would
I don't know, because you told me you were still doing this. So you would have been in, because the price got to 3,400, and what was your target?
Well, my target was for one of the trades was 34,100, but like I said, I was still in the June contract. But when I flipped over on the September contract on Thinkorswim, it already was like 34,200, so it already rolled past the 34,100 on the.
It couldn't be 34,200 on the September yet, because we haven't gotten there yet.
Oh,
So I'm not sure what you were looking at, but send me a screenshot of where you're seeing that.
okay. Well, I'll do it later.
Okay.
Yeah.
But yeah, sometimes, yeah, I just gotta like take your brain off and just do the roll. And then because you get, if you got out here of the June, you'd be getting into September here, and then September goes up and you make your money the same way.
Okay. Yeah. Maybe. Yeah. We'll have to backtrack and see it. Yeah.
Yeah. Rolling is once you get you do it a few
Hey,
times.
Eversley, what's the point I
real
mentioned in
fast.
September and June?
June ends is rollover. The contract ends. The contract literally comes to an end this week. So you have to change contracts. You can no longer, the contract will literally come to an end. So you have to get, if you want to maintain your position, you have to go to the next contract, which is September.
Gotcha.
And if you don't do it yourself, the broker will do it on your behalf, which may not be exactly the way you want it to work out, but they may just close it out for you. But yeah, on rollover day, you roll your positions. And okay, so if you're interested in working with me on this, because we're getting a little bit over time now, but for the futures, we go through at least 10 different strategies that gets you into the currency futures and index futures, and then you can kind of choose which ones you really want to trade, or you can trade them all if you have the resources. The currency futures, you can trade in a smaller account, and it works really, really, really well, especially smaller accounts. you know, slightly bigger account for index futures because the risk might be as much as anywhere between $300 and $1,000 per contract on the index futures for the micros. For the Australian dollars, it's going to be just a couple $100, so you can trade a lot smaller. But the strategies are comparable to what we saw today. They're all those type of strategies where you see something crossing up, crossing down, or hooking up, hooking down, and buy stops and sell stops, the same concept. And we're always looking for probably 40 something to 50 something percent return to first target and 80 to 90 something percent winning trades. So that's very consistent. As long as you're consistent, there are probably 8 to 15 potential trades a month. And I send out emails each afternoon with the trade candidates. So it will help you reduce your time doing the evaluation, because I will help you by sending out the trades that I found valid. So that will help a lot on your end. Then you can validate those, look good. And in your first couple of weeks, you want to just get used to doing your own analysis and then compare it to what I'm sending you. So I've been doing that. And that seems to be working pretty well for quite a few people. The short 1745, if you're doing this with me before the end of the week, I'll take $100 off of that. 1645. It's all one-on-one. Whether if you're in person, great. If you're around Santa Clara, we'll do it in person. Otherwise, we do it via Zoom. Usually around several afternoons a week, evenings by appointment, and Sunday afternoons also. So I'm pretty flexible when we can meet, depending on how flexible you are. And all one-on-one. And however long it takes, I don't cut this. I said 3 to 6 months, but I don't cut people off. I started working with Gordon, who was just speaking, I don't know how many years ago. And I'm not going to cut him off. If he needs help, he needs help. I'll just help him, no problem. And this is for futures. If you want to do futures on options, both those programs, some of you have seen the options presentation. It's $34.95, and I'll take $500 off of this price. That's for both the futures and the options together. This will take a few more months to do them both at the same time. So you got to really learn one, and then that'll help with the other one. But if you're doing both, something will always be making you money while something's losing you money. Futures is trades take a few hours to a few days. Options can take a few days to a few weeks. So that's the difference. But the profitability on futures is very predictable. We can't predict the profitability on options because option pricing varies, but futures pricing does not. We know exactly how much we're going to make or lose on a trade. And it's just like the spreadsheet I just showed. That's pretty much how we do it. And depending on how big your account is, it's just percentage return. We do the exact same trading regardless of how big the account is.
Question.
Yep.
For the currencies,
Yep.
on average, how many do you have on at the same time?
It depends how big your risk is, how it's your stop. If your stop is $88, like the one we calculated, then you mean how many trades?
Yeah, trades. I meant to get trade.
Realistically, you might have 3 to 5 trades, but on at the same time. Realistically, sometimes maybe a little bit more, but 3 to 5 trades is normal.
Yeah, because a lot of it's based on the dollar, the movement of the dollar. So the other currencies might move in sync.
It's just what you saw on the spreadsheet. Is whatever when we get a buy or sell signal, that's it. And just place the trade and walk away. It'll either be a win or a loss. You just set your risk, how many contracts, and like I said, the numbers just work themselves out. And it's always been pretty good to me. Last year, we had a negative year on the index futures, positive year on the currency futures. So it seems to sort of balance out a little bit. So I prefer currencies myself. I can trade size up or down, and a lot of people, I know at least 1 or 2 people I'm working with only trade currencies because they have smaller accounts and they're comfortable doing the currencies because they can trade size down to risking just a couple $100 very consistently. So anyway, we always go over time, and we can do this like indefinitely. I mean, just when does the coaching expire? The coaching doesn't really expire. I've always mentioned his name. He will not come to any of these presentations, but Steve, I started working with Steve back in 2007 or 8. He still emails me every week up to this week to validate his trades are good and his trades match mine. You always want to have someone else to compare to make sure your data is good and everything. People like Gordon, who's been who was speaking a little while ago. Gordon, how long have I been working with you?
Somewhere around since the like 2020 when somewhere around there when it was 2020.
Yeah,
we started with options.
Yeah, it's not an overnight thing. So realistically, you know, when you need help, just call me, email me. It usually hasn't been really a big deal. Just call, email, you need help. Even if it's been a while, call or email me and we'll set something up to get you going. Because I know there's another person who's been working with me a lot longer than that, and he's actually changed his professions to be more of a financial guy now, from engineering. So whatever you need, I don't put a time limit on it. I always put like 3 to 6 months, but realistically, whatever you need, a year later, just call me. So whatever we got to do to get you, if there's something happening that's weird, you need to talk about it. You're getting a string of losses that don't seem right, because I keep posting wins, but you keep seeing losses. We need to talk because something's wrong. There's a disconnect. All right. So I'm going to, yep.
And I definitely talk to you later because I brought up toss and there was a it didn't match with the chart you showed, but I don't want to keep things going. We'll talk about it later.
Yeah, I think Olga was saying, she posted on the thing here that toss didn't roll into September yet. So that's a thing also you got to be aware of. Don't just assume certain brokers' data is always correct. Okay.
I didn't, I guess, well, like I said, that's something we'll talk about because I made that assumption. See?
Yeah, so I actually have 3 different sets of data. I have TOS, I have NinjaTrader, and I have Profit Source. So when there's any question, I look at all 3 sets of data and make sure things kind of match up. And if there's a difference, I also have Schwab, so which is my actual trading platform. So it all depends on if there's any question mark, always double check your broker's platform and something else. Have a second source. If there's a discrepancy, then you can see which one's right. Have a tiebreaker. So I have at least 4 different sources of data, because if there's any question, you can always message me, post it on in our Facebook group. Ask in the Facebook group, does anyone see a difference here? Or, you know, our Facebook group is for that. So we have a private Facebook group. Just ask the question there also. All right, I'm going to wrap it up now. We're probably going to have a meeting in maybe another 2 or 3 weeks after July 4th, most likely. And that'll be on options unless someone wants to do something with futures. I believe that, Olga, I believe that people were day trading June contract on Friday. Yeah, you can day trade. You can keep trading the June contract up until next week. It still exists. You can keep trading. It's just that after a certain date, you can no longer enter trades in the June. You can only exit trades. But yeah, you can keep trading the June contract. But the chart should be showing the September contract after the close last Thursday. That what you see on the chart should be September. And if you're on intraday, then that might be the problem. You got to go to a daily chart. The daily chart should show the September contract. Even intraday, it might not. It might still show June. So it all depends. All right, I'm going to wrap it up. If you need to reach me, interested in working with me on trading, this coding strategy, you kind of know what to expect now. Call me this evening, email me anytime this evening or this week, and I'm pretty available. My contact information is also on our website. If you haven't been there yet, here's our website, and my contact information is there. You can fill out the form for the contact me, or just send the email to the where you see it on the handout. All the trades and here listed here, and the coaching program details are also here. All right, I'm going to wrap it up, and then I'll see you. Best time to contact me, Olga, is anytime. Just email me, and then we'll set up a time to chat. All right, check with you guys. I'll see you guys in a couple of weeks. Thank you.